So for this clip we'll be discussing again the concept of interest parity, but now in a graph. So we're going to develop a graph that allows us to understand and analyze issues in the foreign exchange market in some more detail. We'll do that in 3 steps. First, develop a quick statement of UIP, the uncovered interest parity. Okay. And second, develop the graph itself. And third, importantly, consider how equilibrium in the foreign exchange market is attained. So we'll clear the page here and begin with that quick statement of UIP. So the interest parity condition implies that the rate of return on a financial investment in one country, here the US, in equilibrium in the foreign exchange market must be equal to the sum of the rate of return on a comparable asset in the foreign country, here the EU, plus the expected depreciation. So let's just note this here. E hat ET is the expected rate of depreciation of the dollar against the euro at time t and until time t plus 1. So E hat ET denotes a proportional growth rate, and the higher ET, the more depreciated is the US dollar. So E hat ET is E t plus 1 minus ET divided by ET. So where ET itself is the exchange rate today, and ET plus 1E is our expectation or market expectation of what the exchange rate will be one period hence, at the end of this period. So that said, we have here very simply the dollar return on the investment in the US. Let me write it like that: dollar return in the US, and on the right hand side we have the dollar return in the EU. So the sum of the interest rate in Europe plus the expected depreciation is the expected dollar return on the euro investment. So quickly the restatement here: what if this interest rate is larger than the sum of these two terms? Well, then there will be an outflow of funds from Europe to the US, which implies that the exchange rate today, this one here, falls. So ET today falls as people are as the funds are flowing into dollars and people are investing in the asset that pays the higher rate of return, and as that interest rate today, as that exchange rate today falls, the expected depreciation rises, since our expectation has not changed. So this is the crucial piece here, that we have static expectations, and against that expectation, a lower exchange rate today implies a higher future depreciation, which will lead to equality right here. So beginning with that, let's again clear the page and do the graph. So one, we have our US on the left hand side. We are going to use this graph ultimately to determine, well, what the exchange rate is today between dollars and euros. So we're gonna have our graph with the exchange rate on this axis here, and on this axis we have the dollar return on the US asset. Well, in this diagram, what is this? This is of course just a straight line. We have here our US. The interest rate in the US is independent of the exchange rate, in the sense that the interest rate is determined in domestic financial markets, where the interest rate ultimately is determined by the monetary authorities, the Federal Reserve Bank, and so that we have a vertical line here. Now second, we get REU plus E hat ET, and we're going to draw that in the same space with ET on the vertical axis and the dollar return on the EU asset on this axis. Now, in what sense does this sum depend on the exchange rate? So that's the question. Let's write this out here. So this is REU plus ET plus 1 minus ET over ET. So as ET varies, how does our dollar return on the EU asset vary, given that we assume a fixed interest rate and a fixed expectation? Well, it's easy to see that the lower the exchange rate, the higher must be the dollar return on the EU asset, for the reasons outlined before, that crucially rests on the assumption of the fixed expectation, since a more appreciated dollar exchange rate today implies higher future depreciation. So on a point like this, with a fairly appreciated dollar, the future depreciation implies a higher return. Here, with a fairly depreciated dollar exchange rate, you get no additional compensation from future depreciation, so that the dollar return on the EU asset is lower. Okay, so we have these two curves, and obviously we can combine the two to get our equilibrium graph, or draw this a little larger. So we have ET on this axis and the dollar return on both assets here, and we have RUS independent of the exchange rate and the expected return on the euro asset in this curve, E hat ET. So there we have a point that suspiciously looks like what we might call an equilibrium, and indeed that is the equilibrium. That is where the foreign exchange market is in equilibrium, which determines our ET star, which determines the exchange rate. So the whole exercise to consider the no arbitrage condition and UIP ultimately gives us the exchange rate, determination of the exchange rate. And let's just make this perfectly clear here. That happens in combination with three exogenous variables, which is the interest rate in the US, determined in US financial markets, primarily by the federal interaction between the Federal Reserve and domestic financial market participants. The same for the ECB in Europe. And three are level of the exchange rate expected at the end of the period, ET plus 1. Now, in this graph, what were to happen if we were in disequilibrium? So let's assume that the exchange rate is actually here. What were to happen? Well, the US return is this high, so this is our US, whereas the euro return is only this high. This is the dollar return on the euro asset. Let me not scribble down all those things down here. Obviously, the dollar return is higher than the euro return, which means that we're going to have an inflow of funds into US currency. Europeans are going to begin to buy dollars in order to invest into the US asset, and that means that we're getting an appreciation of the exchange rate today. So from ET, from this level, ET bar, the exchange rate falls to ET star, so that we're essentially moving to this point until we are in equilibrium where the two returns are equal and there are no further arbitrage opportunities. Now, let me click back a little bit here and clean up the diagram, and then just add one consideration, one example. We can think of an example where we now increase the interest rate in the US, so that we're considering a change in one of the exogenous variables. So let's assume that the interest rate, that's a very cranky line, so let's try to get this a little straighter. Doesn't work, doesn't matter. So we're increasing the US interest rate. That happens in domestic financial markets, so let's not be concerned right now how that happens, but you see that this change implies a new intersection of these two here. How is this new equilibrium attained? So how do we get from the first equilibrium to the second equilibrium, which we might call ET star 2? Obviously, when the US interest rate rises, when the US interest rate is raised by US monetary authorities, again, the US return, the dollar return on the US investment is larger than the sum of the return on the Eurobond plus the expected depreciation, which means that there will be outflows of funds from Europe into dollars in order to buy that asset, which implies this appreciation, and that again implies higher expected depreciation, which runs up against the fixed expected level 1 period hence. So that is what in a very simple model determines the exchange rate.